We're going to get a check now of what's happening in the world of business. Our business editor, Kate Moody, is here. Hi there, Kate. America's central bank has been laying out plans to wrap up that emergency help and support it's been giving the economy throughout the pandemic.
Yeah, the Federal Reserve wrapping up a hotly anticipated two-day policy meeting in Washington. The Fed says it will be phasing out its monthly bond purchases by March. And if the economic recovery remains on track in March, it will then likely raise interest rates, which currently sit between 0.25%. Analysts are expecting up to 5 rate hikes in 2022. The Fed is trying to clamp down on inflation, which hit a 40-year high of 7% in December. Take a listen to the Federal Reserve Chairman Jerome Powell speaking just a moment ago.
While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability.
Let's speak now to Nancy Vanden Houten, lead US Economist at Oxford Economics in the US. Thanks for being with us on France 24 this evening. Jerome Powell there. Oh, we seem to have just lost that connection there with Nancy Vanden Houten. We're going to try to get that back for you to get a little bit of analysis on what's happening with the U.S. Federal Reserve, very widely expected announcement that the central bank will be planning to raise its interest rates, that key federal funds rate, to try and fight high inflation. That's expected to come in the months to come. Nancy Vanden Houten from Oxford Economics. I think you're back with us now. Thanks for your patience. Sorry about those technical problems as we try to cross over to you. Jerome Powell there said that the central bank would remain nimble when it comes to raising interest rates. Was his statement about the next steps broadly in line with what you were expecting?
Yes, very much so. The Fed sent a very clear signal that they're going to be raising interest rates at their March meeting. And I think, everything else in the policy statement and what Chair Powell had to say in his press remarks so far is in line with our forecast, which is for the Fed to raise interest rates a total of 4 times this year. Also, they signaled that they will be withdrawing some of the other emergency support that they have provided during the pandemic. Primarily, they're going to start reducing this massive portfolio of securities that they've acquired, which has been another way of propping up the economy during the pandemic.
Now, the main focus at the moment is really trying to get a handle on this really hot inflation that we've seen in the U.S., 7% in the month of December. Remind us how the Fed's actions are intended to do that.
Well, I mean, this is a very unusual experience where much of this inflation is driven by supply side bottlenecks arising from the pandemic. So in reality, the Fed's traditional tools, are not really designed to address that. But raising interest rates and withdrawing other measures of support will suppress demand a little bit. And the Fed, expects, and we do as well, that will help chip away at these high inflation rates at the same time that supply chain bottlenecks start to ease.
As you mentioned, the Fed is also phasing out its monthly bond buying program, but not reducing its balance sheet or bond holdings. Is the central bank hitting the right balance here, do you think, when it comes to withdrawing its support?
Yes, I think so. I mean, they will, they indicated that they're going to start actually reducing the size of the balance sheet, sometime after they start raising interest rates, which we expect to happen in March. We think that they'll pivot pretty quickly from stopping increasing the balance sheet to reducing it, and are looking for that process to get underway in July. We think they will follow a similar process as they did after when they reduced the balance sheet following the global financial crisis, but that they're going to do it at a much faster pace this time around.
Now, the Fed's goal of reaching full employment has effectively been met, according to that latest statement there. But there are still a lot of challenges for the U.S. labor market.
There definitely are, and sort of like inflation, the Fed's traditional tools are limited in just how much it can accomplish at this point. I mean, one of the big challenges for the labor market is getting people to rejoin the labor force, and the pace at which that happens will depend very much on the course of the virus. I think that the Fed and many of us private forecasters thought more people would return to the labor market sooner, but the virus is not predictable, and so we still have individuals confronting challenges like childcare or concerns about health that are keeping them from coming back to work. So we do expect that process of people rejoining the labor market to continue, but again, to use one of Chair Powell's words, we have to be humble because we really can't predict the course of the pandemic.
Humble and nimble were, I think, the words he used there to describe the Fed's policies there. As you say, there is still quite a lot of uncertainty out there, notably about the pandemic. Yesterday, we saw the IMF scaling back its forecast for growth in the United States. Give us an idea of where the American economy stands at the moment.
Well, we think that Omicron is going to take a pretty big toll on the economy in the first quarter, with growth coming in less than 2%. But we're looking for pretty good bounce back in the second quarter, and for the year overall, we look for growth of about 3.5% to 4%, which will be less than in 2021, but still a reasonably good number. And it's important to remember that even with the Fed raising rates, if they are to raise rates to the level we expect, which would be a little bit above 1% at the end of the year, that's still an accommodative level of interest rates. They are withdrawing some support, but it's still a level of interest rates that should support a decent pace of economic growth.
All right, Nancy Vanden Houten from Oxford Economics, thanks so much for bringing us your insight here on France 24 this evening.
Thank you very much for having me.
Well, let's check in on the day's trading action now. Investors around the world were looking to see how aggressive or not the Fed would be in tightening monetary policy. Wall Street has now given up some of its earlier gains, turning red there as this volatile trading week continues. The Dow Jones, S&P 500, and NASDAQ each down nearly 1 percentage point each there with just under an hour of trade to go. The prospect of higher interest rates in the months to come slightly spooking investors, even though it was widely expected. Earlier, we saw the major European indices closing higher, gains of 2 percentage points in each Paris, Frankfurt, and Milan, about 1.3% in London. More than a third of workers at the French power giant EDF were on strike today over the government's efforts to reduce electricity bills. Energy prices have been soaring across Europe. The French government's trying to protect consumers by offering €100 vouchers to the most vulnerable and putting a cap on electric and gas bills. It's also ordered the power utility to sell energy at lower prices. Claire Rush has more.
More than a third of EDF employees were on strike on Wednesday, including these workers at a nuclear plant in northern France, to protest against government orders that EDF sell cut-price energy to its competitors.
Nous, on demande au gouvernement de revenir sur cette décision. Éventuellement, des possibilités existaient, par exemple une baisse de la TVA. On aurait pu aussi imaginer une offre commerciale d'EDF auprès des clients les plus fragilisés.
French authorities have imposed a 4% cap on hikes in electricity bills, which they say could otherwise soar up to 40% because of rising inflation. To achieve that goal, the government has ordered EDF to increase the amount of nuclear-produced electricity it must sell at under-market prices to rival home suppliers. The measure is expected to cost the company nearly €8.5 billion, sparking criticism at the French power giant, which generates roughly 70% of the country's electricity with its 56 nuclear reactors.
Donner une part, presque un tiers de sa production à la concurrence qui n'investit pas un seul centime d'euro dans la production ou dans le coût de manœuvre, c'est néfaste pour l'avenir de l'entreprise.
The government, which owns 84% of EDF's shares, says the concerns are unfounded.
lorsque cette entreprise est en difficulté à cause de tarifs bas, elle est soutenue par l'État. Qu'elle a reçu 10 milliards d'euros d'aide, il n'y a pas de raison de s'inquiéter pour l'avenir d'EDF.
EDF is already struggling with maintenance of aging nuclear reactors and with delays and cost overruns for its project for a new power plant in northern France.
Very high stakes there for EDF, for the French government, and of course for French consumers.
Okay, well, thank you very much indeed. Our business editor, Kate Moody. Thank you.